Good evening, members. I welcome you all for this study circle meeting on the topic foreign tax credit. And to dwell upon this subject, we have CA Sumeet Khurana sir with us. May I request our CA Pramod Hegde, Vice Chairman, to escort the speaker on the desk and then welcome him with floral bouquet. Thank you. Request Vice Chairman to give.
Good evening, esteemed members, distinguished guests, and our speaker Sumeet Khurana ji. A very warm welcome to all of you. In the era of globalization, where business are transcending the borders and in line between the domestic and international transaction is becoming increasingly blurred. Why? Because the subject of foreign tax credits has become very crucial in its era where principle of taxation meet the practices of the global operations. Foreign tax credits are just not the numbers and percentages. They are about ensuring fair taxation and avoiding double taxation, thus facilitating the international commerce. It's a topic that not only affects the multi-corporations but also influences on the startups, individual venturing into international transactions as well. Today we aim to dwell deep into this subject to see its complexities and understand its implications, just not an academic exercise but also to service our clients. And of late, we have this trend where you have a lot of finance influencers who are coming in your shops and they have been advising our clients on how do they do international transaction, how do they maximize their interest also. So of late, from my previous year personal taxation, I see a lot of individual clients as well who have entered these into international transaction, being it in a financial transaction or otherwise. So in my conclusion, let me quote Albert Einstein that the important thing is not to stop questioning and may our quest for knowledge and understanding never end. That's the agenda of a CP as well. Thank you. Let's embark on the enlightening journey together. Enjoy the session. Over to our secretary for a
Thank you so much. I have a privilege in introducing today's speaker. CA Sumeet Khurana ji qualified in the year 2001. Since then, he is into practice of income tax. His focus is largely on litigation and appear before various appellate forums. Besides that, Sumeet contributes his thoughts by writing articles and speaking on different forums. With this brief introduction, I present before you CA Sumeet Khurana ji. Over to you, sir.
Good evening. Thank you, sir, for the introduction, and I thank the branch for giving this opportunity to be here. Today, the topic is foreign tax credit. That's the title given. The title is short for convenience. Actually, I am going to cover not only the foreign tax credit but also the exemption method, because that's the scope of the Article 23 of the Model Convention. Will deal briefly, though the exemption method is not very popular, but for the academic completeness, we will deal with both of these. So as you can see on the slide, the title I have modified and I have taken, it's not my brainchild, I have borrowed it from somebody. It's elimination of double taxation is the heading of the title, but truly it means it's elimination of residual double taxation. Because largely, to some extent, the double taxation gets mitigated or avoided by the distributive rules. Article 6 to 21, which talk about different streams of income. They may say that a particular income, then that article, it may be taxed only in a particular country. So at the threshold itself, if the article says that only one country has a taxing right, then the threshold itself, double taxation is avoided or mitigated. So what will come here in Article 23, in the FTC or exemption method, is only what still remains after application of Article 6 onwards. So when we talk about avoiding double taxation, there are two kinds of double taxation which we typically see. One is economic double taxation, other is juridical double taxation. So juridical double taxation is when the same entity, same taxable entity is taxed twice in country A as well as country B. Economic double taxation is when the same stream of income flows from Mr. or A to B. A is also taxed, B is also taxed. That typically happens in the case of dividends. So when the company earns profits, it distributes dividend. First the company pays tax and then the shareholder pays tax on the dividend received. So that's economic double taxation. We'll see how to what extent the treaty assists in avoiding economic double taxation also. So juridical double taxation, there can be three ways predominantly. Dual residency. An entity is a tax resident of two countries at the same time. It can happen because different countries have their own mechanisms of determining a residential status. You can be a resident of country A as well as resident of country B. So if there is dual residency, the elimination of double taxation happens by resorting to Article 4, which tells you how to narrow down to residency of one country. Typically now in the present status, it is to be resorted to mutual agreement procedure between the two countries. So you become resident of only one country by tiebreaker rule of Article 4. That is how you avoid or mitigate double taxation from the dual residency perspective. The second is by resident and source conflict. One country taxes because the entity is a resident here. The other country taxes because the income is sourced from that country. So an Indian tax resident deriving dividend income from say German company or a German Indian holding company having German subsidiary and German subsidiary gives dividend. So it's Indian companies getting taxed in India on the dividend received because it's tax resident of India. Germany is taxing it because it's a income dividend income sourced from Germany. So source resident taxation, largely Article 6 to 21 will deal with it, and whatever still remains as we discussed will be dealt by Article 23. And there is third kind, which is source versus source double taxation. For example, there may be a PE in one country. Suppose a US company is having a PE in India, and that Indian PE is holding shares of a French entity. So France is taxing that dividend because it is sourced from French company. India is taxing dividend, that same dividend received because there is a PE in India, and then resident country will tax it. So this is tripartite situation. We'll deal with this at the end of it. So that these three kind of maybe the double taxations are there.
Sir, for PE things, my understanding, correct me if I am wrong, only the Indian income will get taxed because it's a PE. Will the global income also get taxed in India?
Also, what I mentioned in the facts of the case was that the PE is holding shares of the French entity, for example. So when
PE will not be a legal entity.
PE is not a legal entity, you're right.
So,
So what happens is in the context of a PE, the PE gets taxed for the actions it performs and for the assets, the income from the asset it owns. So it does not have a legal ownership, but in the context of international tax, what we deal is, it is the economic ownership that matters. So if the PE has been given funds, now the persons who are manning the PE, there is a branch here, say for example, and the people in the branch decide, I will to invest there, I have to lease this asset there. So if they perform that significant economic function of deciding how to utilize that asset, and that asset earns income from the third country, then that can happen. It's not very uncommon. It's not very common, but not very uncommon also. Okay. So in the economic double taxation, as I said, that typically it is the dividend taxation, and also from transfer pricing it can happen. So if there is a transfer pricing addition made, say for example the German entity is having a subsidiary in India, and because of their transactions in between, the Indian company, though it offered tax at the same cost plus 15% markup, the Indian tax authorities say no, it should be 20%. So Indian company, say Indian subsidiary has raised invoice on the German parent at cost 100 plus 15 markup. The German parent has absorbed the cost of 115. Indian tax authorities raise the margin to 20%, make it 120. but the German counterpart is not going to give deduction of 120. So that extra 5 is getting taxed in India as well as Germany. So that is another kind of economic double taxation, which to some extent is taken care of by Article 9.2. Article 9.2 provides a kind of correlative adjustment. So if there is an article in the relevant treaty which is corresponding to Article 9, Para 2 of the OECD Model Convention, that can avoid that double taxation by expecting Germany to give extra deduction of that 5. Not to,
Sir, unless Germany pays you that extra 5%, how will they pay tax on the 5%?
so whether they will pay or they will accept that there is an addition, actually it should have happened. So the Article 9.2 says they have to give corresponding correlative adjustment. If they accept that, actually they should have done so.
Indian tax authorities are not bothered whether the subsidy is actually raising the invoice at 20% or 15% or 100%.
That's right.
They will notionally decide that the transfer
That's
pricing is 20% and
right.
tax.
That's
So
right.
as long as the Indian subsidy pays the tax at 20%,
Right.
that's all. They are not
From
bothered
India
further.
perspective- From India perspective, it is fine.
Yes.
But if the India-Germany treaty has got an Article 9.2 kind of a requirement paragraph, then OECD Article 9.2 mandates that the other counterparty has to give benefit of this deduction. That's the if they have agreed to do so, they have to do so. Otherwise, they should not negotiate that article. See, many countries do not have that in their treaties the Article 9.2. But those countries who have agreed to provide 9.2 article, they have to abide by that. So the person who is typically eligible to claim this exemption and credit is the person who is resident of that country. So if a person is resident in India, India will give the benefit of exemption or the credit as the case may be to its resident. So the respective resident country is the country who has to give the benefit. Non-resident only for the academic completeness, the section 91 which deals with the unilateral credit. It says that non-resident person who is a partner in a resident, who is a partner in a firm resident in India can avail that benefit. Practically, it's not going to be applicable. In the case of resident also, it includes the RNOR, the resident but not ordinarily resident, is also treated to be resident for the purpose of claiming Article 23 benefit, whether it's FTC or exemption method. So, how I have structured this today's discussion is, we will have it into two segments. First, we will deal with the text of the article, but it's very important to focus on the text of the article. Most of us do not memorize it like that. We have to read that again and again to see how the interpretation has to flow in a particular facts of the case. So we'll deal with the article's text and then we'll go to the various case studies. So dealing the exemption method first, Article 23A, one of the OECD Model Convention says that if there is a person who is resident, say for example resident of India, who derives income which may be taxed in other contracting state. The Indian resident is deriving dividend income from Germany which may be taxed in Germany in accordance with the treaty. So the taxation by Germany is not solely because of their domestic law, it is not in contravention of the treaty. India-Germany treaty is also permitting that taxation. So if that is the case, then first mentioned state, which is India here, shall exempt such income or capital as the case may be. So this is primarily laying down the foundation for an obligation of the resident country to give exemption. Now this is subject to two exceptions. First exception is, first of all, the exemption method is rarely followed in a very limited number of countries. Even if there is an exemption method followed, it's carved out an exception that as far as dividend, interest and royalty income, FTS income is concerned, they follow the credit method only. So that's the first exception. So first exception is...
this goes against the section 9, that residential status. So even though the company is a resident of the first mentioned state,
right,
it will get taxed only in Germany and not in India.
Correct.
In the normal parlance, if we go by the provisions of section 9,
Section 9
it will
probably,
be taxed in India only,
yes.
but it will not be.
Because you have agreed upon with the other country to forego that tax. So that is why we say treaty overrides the act in general cases. Okay. So now the first exception is in the middle of these two, that is subject to paragraph 2 and 3. Paragraph 2 deals with taxation of dividend, interest and royalties, etc. and paragraph 3 deals with it, rather it reduces the main basic exemption method to exemption by progression. We'll deal with that in a while. The real exception is in this red font. When the resident country is not obliged to give credit is when the other country is also taxing in the capacity of a resident country. If both the countries are treating that person to be resident, then the question will be which resident country has to give credit. So then what we have to do is, we have to read this exception very carefully. We have to examine both the resident countries. Take a case where there is an R1 and there is an R2 country. R1 is country of resident 1, R2 another resident country. We'll deal with a case study on this in the next slide. So if R1, from the perspective of R1, if you examine, if R2 is taxing it solely because that is a resident, because that's a resident country, then R1 is not obliged to give credit. So I'll just read out this exception red font where the treaty allows taxation by other state, which is supposed to be source state, but solely because the income is also derived by resident of that state. Now I'm just requesting you to bear this phraseology in mind. It will be clear in the next slide.
But your first statement gives that impression only. Why there is this except clause need not be there, no? Your first mentioned thing.
1 minute. We'll read this case study. It will be clear. So Mr. A is in state R1. He is a resident of that state for financial year 2021. For the sake of simplicity, assume that two countries have same financial year April to March. He exercises employment in R1 state. He is given ESOP by a company in R1. ESOP is, you may know, ESOP has stages. First it is grant, then vesting happens, then exercise broadly. So the country gives a ESOP. ESOP is granted to him. By March 21 it vests also. But there is a period of 2 months for exercise. This gentleman moves to R2, another country, and becomes resident of R2 in next financial year. He exercises ESOP in R2 state. Now R1 has its own domestic law, R2 has its own domestic law. R1 domestic law says I will tax in the year in which ESOP is granted to you or if ESOP is vested in your hands. R2 says I will tax in the year in which you exercise. Like India, in our case, if you take India as an example, section 17 says in the year of exercise we will tax you as a perquisite ESOP. But there are countries which tax on the ESOP vesting itself. So if that kind of conflict happens, now see the beauty of this case. He is a resident of R1 in financial year 2021. He is a resident of R2 in financial year 21-22. In both states he is resident, but in two different time periods. Article 4, which is typically capable of resolving the dual residency conflict, is failing here. Article 4 operates only when he is a resident of two states in the same contemporary period. Here the period is totally different. So Article 4 is unable to resolve the conflict of dual residency. Both states are taxing as a residents. So the question there is, who will give credit, who will give exemption, if at all? Now if we go back to the exception, it may make some better sense. That exception says, now look at from R1 perspective first. R1 is to give credit except when the other state, which is R2, is taxing solely because of resident. Is R2 taxing solely because he is a resident? Yes. Now examine this from R2 perspective. R2 has to give exception, R2 has to give exemption except when R1 is taxing solely because of residence. Now let us examine, is R1 taxing solely because of residence? Of course that fellow is resident there, but he also, in the facts of the case, you remember, he also exercised employment there. So therefore, had he not been resident, he would have still been made to pay tax in that country because he has exercised employment, is a source also. So R1 could have taxed on two reasons. One, residence. Other, because of exercise of employment, it becomes a source country also. So if you see from an R2 perspective, R1 is not a country which is taxing solely because of residence. The word solely is very important. R1 is not taxing solely because of it is taxing also because of residence, the source of income being there, because of exercise of employment there. So therefore, R2 is a country who has to give exemption or credit as it is.
Sir, in India also, if the income has been taxed already on accrual basis, it cannot be again taxed on receipt basis.
True.
So in R2, it is more or less like a receipt rather than accrual has happened in R1.
That's a different concept altogether. Okay.
Because the same income by two acts cannot get taxed twice, right?
See, we are dealing with two different countries which have two different domestic laws. Within the Indian Income Tax Act 1961, within that scope, double taxation on accrual as well as it cannot happen. But here are the two countries, they have their own domestic laws. They will tax as per their own whims and fancies. As we have our whims and fancies in the Income Tax Act, there are so many whimsical provisions, no? Isn't it? There are so many provisions which do not make sense to us. There may be other brothers and sisters who have similar mindset of taxing on different basis.
You mean to say accrual and residentiality of that country will be considering for the taxing?
See, we have that country, sorry, come again, maybe I'm not.
As he said, the accrual basis where we are following, we know that Indian income tax.
Correct.
But other country, how it thinks about the accrual
Yes,
basis?
we need to know. So we don't need to know the law.
Yeah.
Because the very fact that they have taxed it will be a primary factor to questioning why you have taxed it. So the moment you start investigating why they have taxed it, will give an answer as to what is the legal framework around it. So coming to Article 23, Para 3, I said that the 23-month exemption is subject to two paragraphs, Para 2 and 3. Para 3 we will deal first and Para 2 will deal a little later. Para 3 modifies the exemption method to from basic exemption method or the exemption pure exemption method to exemption by progression. What it typically says is that if the domestic law provides that the so-called exempt income will be considered for rate purposes, the way we consider agriculture income for rate purposes.
Sir, this article number 23A,
From the OECD.
will it be the same for all
No,
countries?
no. It differs.
Because you are discussing as a standardized
So
article.
I have taken it from OECD. What we have to do is we have to go to the respective treaty. It will typically be somewhere between 22 to 25. Near that range, because
So OECD is just a guidance.
OECD is just a guidance.
It
Just
doesn't
guidance.
have any statutory sanction.
It doesn't have statutory sanction, yes.
Because if you quote OECD before tribunal, they will not, the honorable members will not take it.
Significantly. Our Supreme Court in the engineering analysis have followed it. And the way people are reading it, the way people are reading Supreme Court engineering analysis, software case, you will be knowing it, that most hyped matter of international taxation, the software whether royalty or not. There the Supreme Court has taken the OECD as its sacrosanct and it is binding on me. People are reading, I don't agree with that, people are reading as if now it is blessed by Supreme Court that no OECD is binding. But that's not really the case, but it's having a high persuasive value. So this Article 23 the exemption, it modifies the exemption method to exemption by progression. What it really says is if the domestic law provides that for the rate purposes I will include that income which is otherwise exempt by the treaty, then that will be okay. That's okay with us. That is not in contravention with the treaty. So this article really permits if domestic law is there. It doesn't create any extra charge. So just taking it illustratively, numerically just to have a flavor, take a case where there is total income of 1 lakh, 80,000 in state R, resident state and 20,000 in source state. If there is full exemption, what the state R will do is it will tax only 80,000. 20,000 will be taxed by source state. Now, take a case, a variation where the domestic law provides of the state of resident that my tax rate basically is 25%, but if the income exceeds 80,000, then entire income is taxed at 35%. If that kind of provision is there in domestic law, though the income is otherwise exempt, it is not to be taxed. But what will happen in the second column, if you see, the 35% tax rate will be applied on the 80,000 income. Though 20,000 is not getting taxed, if the domestic law permits so, it will be considered for rate purposes, and since the by inclusion of that 20,000 income is going beyond 80,000 of scale and tax at 35% applies, they will be permitted to tax the 80,000 also at 35% tax rate. Source state tax remains the same, which is 20% of that 20,000. I hope it is clear, we can proceed. Now this 23A4 is a very interesting animal. Primarily objective of the tax treaties is to avoid double taxation. This 23A4 is out of anxiety to avoid double non-taxation, because what happens is people take such positions or such structures that a particular income is not taxed in country A as well as country B. So if the double non-taxation is happening, then this article is coming to take a rescue for the department, tax department, that no, this exemption should be denied here. It has a limited scope. Let us take a look at it. What it really says. It says in a particular case, para 1 will not apply. Para 1 says exemption has to be granted. This says para 1 will not apply means exemption or credit has not to be given. When the other state applies this convention to exempt that income. Resident country is primarily obliged to give exemption as per 23A1. But if the other state also applies this convention to exempt, then a resident state will not exempt. You will see some case study on this. The second exception given is very normal, that in case of, because we read in the this thing that in case of dividend, interest and royalty, exemption method is not followed, only credit is followed. So that is the second exception here.
Sir, one point here. If it is exempted, so is it the conclusion that it will be taxed at least in one of the countries? If it is income.
1 minute, sir, 1 minute. I will answer that because there are 2-3 permutation combinations. Okay. So the objective of
So
the
you will use the Hutchison Vodafone merger case here and give the example, sir.
see, I will not deal with any particular facts of the case. Okay, because that's a different problem. We will deal with this if the time permits. At the end, we will deal with whatever fact pattern you want to share. Okay.
I
So
think
now,
my friend's question is that only.
okay, we'll come to that. We'll come to that. We'll cover the basic stuff first, and we'll come to your example.
No problem.
So this one, so what it really means is that even though there is an obligation to exempt, but if the other country is applying the treaty in its own way, because everybody has its own understanding. No, I read in a different fashion. My interpretation is different. Your interpretation may be different. So the other country has a different kind of reading, and it believes that it is also not obliged to tax. It is also obliged to exempt only. Then the resident country gets back its right to tax. But another element to be factored here is there may be two situations. One, the other country is not taxing because the domestic law does not have a provision to tax it. Or the other country has a domestic law provision to tax it, but another deduction or exemption is given. So if because of domestic law there is non-taxation in that country, then the resident country is not empowered to tax it. So the moment the other country is not taxing, first you have to ask why it is not getting taxed. If the person is able to demonstrate through the domestic law provision that this domestic law is exempting me, then he can have a breather, he will not be taxed in the resident countries.
There may be a situation like in the case I explained. Cayman Islands is a tax haven. There is no domestic taxation there.
Correct.
So the share transfer between two holding companies happen there.
Correct.
It is not getting taxed.
Right.
But the underlying asset is in India, which is the subsidiary company.
Right.
Okay, so it will not get taxed because the transfer has not taken place in India.
Correct.
So we wanted to do a retrospective amendment from 1961 to tax that transaction in India.
Right.
And now they went into international arbitration, and we have also removed that I think when Mr. Jaitley was the AFM, that retrospective amendment was removed.
It was withdrawn, yeah. Retrospectively was
So in that case, and we have also agreed to pay the tax wrongly collected if it is going to be wrong. That is also refunded. So in that case, the capital gains has not got taxed in anybody's hands, either in Cayman Islands or in India. So is it fair?
Taxation.
It is not fair, sir.
Let us not get into fairness. We will first deal with law.
Sir, fairness has to be seen not from moral grounds. Any one of the two governments should get revenue.
So,
sir.
no, I totally agree with you. I totally agree with you. The thing is, they should not then negotiate treaties of that kind. See, if there is the point we're trying to bring out here is, if the non-taxation is because of somebody's domestic law. Okay, now there is a Cayman Island.
Yes.
It says in my domestic there is no tax. Then India should not have a negotiation treaty with that country to say I will also not tax it.
Yes.
Why should you have it?
Yes. You should not have.
You should not have that kind of thing. But if you have signed that treaty with whatever political reasons, so you are bound with that. Then you cannot have in the courtroom grievance that no, my lord, both countries not taxing. Don't sign that treaty laws. So that's a simple point. So if there is a domestic law intervention, if the non-taxation is because of domestic law of a particular country, double non-taxation is permitted, kind of. If it is because of their treaty understanding, then the resident country is not obliged to give that exemption.
No,
We'll see that
is
case.
that, see, Cyprus and all our countries, they have been designated as tax havens.
Correct.
That means you yourself is saying that I don't tax. Then where is the question of taxing that income in other country? You are invited every country to come and invest, and we don't. We say that we don't. We need not pay tax here.
So that's a thing. That factor has to be borne in mind if you are going to negotiate treaty with that country.
Yeah.
If you do that blunder and you hit your own economy, who will there rescue you?
No, after signing the treaty, they will change the domestic law to make it exempt.
Sorry, come again.
After signing the treaty, in the domestic law now the income is exempt.
That's another complication.
Like
So,
for India, earlier,
when you sign the treaty, that country has a right to tax, you're saying,
yeah,
and later on that country after see they will not be waiting for one country negotiation treaty and then exempt there. Typically that will not happen. I don't know if you have a particular experience for a particular country who has been waiting for negotiation of treaties and after that exempting it.
Sir, sorry, very important is question. Now we have got one choice. Let us take the Indian taxation and double taxation treaty to your side of the country. Now the thing is that assessee can take advantage of the DTAA or the local taxation. If under DTA is not taxable, under domestic it is taxable, then I opt for the DTA. There is a choice to the assessee that either you go for this or that. Correct?
And recently is a very interesting element on that. They have gone ahead to exercise that choice to the extent that I have a short-term capital gain or loss and long-term capital. There is one like the long-term capital gain, short-term capital something. For one stream of income, they use the treaty. For other stream of income, they use the income tax act, and the tribunal has
But still
blessed
it is correct. Maybe the tribunal has to read it closely because the benefit, it is the choice given to the assessee that he can take advantage whatever is the
That's
benefit.
right. I am
He
agreeing.
should not be denied that.
I am agreeing with you, but the thing is, can you exercise the choice in a manner that long-term capital gain, treaty exemption, short-term capital list, I carry forward in the act.
Where
I
it is
follow
like-
act for this stream of income, I follow treaty for this stream of income. Is it permissible?
And whether it's, let us go by the law, not on the logic. Okay, let us go by the law. Where it is prohibited that once you use it for long term, you should not use it for short term or the vice versa. So nowhere it is stated, Indian income tax or DTA. If it is there, I will be happy to read it again. He says that you take advantage of the whatever is beneficial to the taxes. Sorry,
No, perfect. I have no difficulty on that. You are most welcome to give your thoughts and interventions, no difficulty. I had the same feeling that sir also is it fair? Or I don't know, whatever word you want to say, I felt very unfair. See, it may be beneficial to my taxpayer client and all that, everything is okay. I felt it very unfair. But the thing is, when I struggled to find, is there any basis to deny that, I could not find it, as you're saying. So, the only thing is there, that in the India-US treaty, There is a separate technical explanation US has released. US has given technical explanation for the India-US treaty. I guess it is there in the US model commentary also. Okay, they say that treaty and act, this thing choice should not be exercised in an inconsistent manner. Now, where is the basis for that? Maybe they have there in their internal IRS regulations something, I don't know. But at least in domestic law, Income Tax Act 1961, there is no such thing. But the US commentary says that it should not be exercised in inconsistent manner. That may be logical,
He is
rational.
saying inconsistent year by year. He is not
No,
saying in the law itself.
within the year.
I said.
Within the year. And year by year, I think there is no difficulty. Year by there is no difficulty. Within the same year, they say for one business, you are saying I am taxing, I am saying there is no P. Other business there is a loss. I am saying no, I go by domestic law. They take the very example of business. One business making profit, other business making loss. They say don't use it in an inconsistent manner. I don't find any justification, legal justification for that. It may have an emotional justification, not legal justification.
Logical.
Sir, this
Justification.
GAR has been implemented, sir.
Yes, implement.
Implemented means,
Notice
suppose
is
even if you are
applicable.
permitted to go by treaty for one head of income or one transaction, and by the provisions of the income tax for another head of income or transaction,
Right.
just because it is more advantageous to you.
Right.
But under general anti-avoidance rules,
There's
this will be
nothing-
prohibited, right?
No.
No.
It will not be?
No.
Now just take an example, sir. Some case study. Mr. A is a resident of state R. He is a partner in a partnership firm in state E. There is a partnership firm in state E, which is a kind of resident there. There is a domestic law difference between state of residence and state of P. Domestic law is different. Resident state domestic law says a partnership firm is equivalent to a company. If you sell, alienate your share or interest in the partnership firm, tax treatment is similar to selling the share of a company. And between the two countries, the treaty says sale of share of a company will fall into residuary Article 13, and that 13 article gives the right of tax to the country of residence. The resident shareholder, that country will tax the alienation of share in the entity. The P state says my domestic law is different. I have my choice of drafting my domestic law. According to my domestic law, partnership firm is what is called fiscally transparent, which means I don't tax the partnership firm as firm. I straightaway tax the members. And as a corollary to that, alienating the share in the partnership firm is equivalent to sale of underlying assets. And since there is a P in my state, you are selling the shares, you are selling the assets of the P, and as per Article 13(2) of the relevant treaty, it is tantamount to sale of assets of the P, and therefore I have a right to tax. So both the countries are believing that they have a right to tax because their domestic law is different. State of P believes, as per my domestic law interlinkage with the treaty, the sale of partnership share is equivalent to sale of underlying asset, and sale of underlying asset actually is sale of assets of the permanent establishment. And since P is in my state, I will tax it. Resident country says, if you sell the share of partnership, it is equivalent to sale of share of a company. Sale of share of company of any other country, resident country will tax it, therefore I will tax it. So this is a conflict between the two countries. Now, whether state of R is obliged to give exemption or credit, both the countries believe they have a right to tax it. Question is state resident bound by the understanding of state of source? Here what OECD recommends is that if divergence of reading, see both the countries have different understanding, both the countries believe they have a right to tax. If this kind of different understanding is because of interplay of domestic law, it is because of interplay of domestic law, then resident country should surrender. It should give the exemption of credit as the case.
Sir, in countries is not treating the partnership firm as an entity.
Correct.
It is taxing the partners for the profits or alienation of their
Right.
partnership rights.
Right.
Okay. Mr. A.
Mr. has alienated the shares of the
Correct, sir,
firm.
but Mr. A is a resident of state R.
Ah, correct.
He is not in E.
He is not in E.
Therefore, it should have been taxed in the hands of A, but A is a resident of state R, and therefore R only can tax. Or A is not a resident in E. Only the partnership firm is a resident in E.
You're right, sir.
So if A had been a resident in E, it might have the right to tax in the hands of A in state E.
No,
Since
that we are, no, what we are overlooking is the domestic law of state E interplayed with the treaty. Domestic law says I have a right to tax because of sale of assets.
irrespective of where the partner resides.
For example, sir, there may be a company resident of Singapore. It is selling the shares of Indian company.
Correct.
Citus is India, no?
It will get taxed in India.
Yeah, that's likewise the citus of the underlying assets is in state E. Therefore, the state E believes that because assets which are being sold are lying in my state, therefore I have right to tax. And treaty permits that because treaty they are being applying. Article 13(2) says sale of assets of the PE. Income will be taxed in the state where PE is there. So here is a classical case where there is a domestic law interplay with the treaty. So every country understands the treaty in the light of its own domestic law, isn't it? They have their different domestic law provisions. They are taxing it as per their understanding. So here, when the conflict is there the OECD says is that the resident country should surrender or submit to the domestic law interplay of the other country. But if it was a pure treaty interplay, next case we will see pure treaty interplay, no domestic law intervention, then the answer is different. We'll just see in a minute.
But even in the clause by clause submission of reports, etc., we are talking about now, sir. So, suppose let us see R is a Singapore and E is India. Let us
Just take 1 minute, sir. If you can withhold your case for 1 minute, we'll take this example and then come back to your question.
Perfect.
Okay, sir. Now, this second example is almost the same. The exception is that here, while state of P believes that there is a P, state of R says no, there should not be a P there. According to the treaty, as read and understood by state of residence, there is no P. See, P is a very fluid concept, if you know. Whether in a particular facts and circumstances there will be a P or not can be highly debatable contentious issue. So state of P believes there is a P. State of R says you are misreading the act, you are misreading the treaty, you are misapplying the principles, there is no P. Here is a case where they are reading, the two countries are reading the treaty in a different fashion, different understanding. The question is whether state R is obliged to give exemption or credit or not. Here the OECD says state R will go by its own understanding of the treaty. It is not obliged to surrender to the understanding of the other state. Other state believes because of misinterpretation of documents, misinterpretation of any evidence or misinterpretation of treaty or correct interpretation also, I don't know, because who is the judge here? There are two countries fighting with each other, who is the judge? Resident country is the judge is what typically they say. So resident country will not surrender to the other countries understanding, misunderstanding, correct understanding of the treaty or facts. Now very interestingly, there has been a Madras High Court judgment. There is a case where there is a P in Sri Lanka. Sri Lanka did not tax it. For their domestic law did not provide for something, whatever exemption, etc. And somehow this SSC gets some confirmatory letter from the tax authorities that there is a P there. And India Sri Lanka Treaty Act at that point of time provided that if there is a P in other country, India will not tax it. So there it is not taxed. Here it is not taxed. The Indian authority says there is no P allowed in the country Sri Lanka. The High Court says that country saying there is a P, no, you keep quiet, there is a P. You don't apply your P. So what OECD says, you don't submit to the other country's understanding of P. Madras High Court said, they did not look into OECD commentary, they did not refer to anything. But the point here is we have a High Court judgment vis-a-vis OECD commentary. High Court is going to be more persuasive in that sense. But I know doesn't seem to be very appealing to me. Maybe I'm biased towards OECD. I can't say that. Anyways, now we can compare this.
No. I was only saying, in the resident state, ignoring that it has already been taxed in state yes. Suppose it has the capital gains, because the partnership share is treated as a capital asset,
yes.
and therefore capital gains.
Yes.
Even in this state, it is treated as a share in a company and therefore capital gains. If that is added to his total income and taxed as per the tax rates of R, then the tax you have paid
In that country.
in yes, you will always take a credit, right?
No, you will take a credit. There, that's what they're saying. No, if it is there, they are saying you will give credit. If it is
You tax the above the line, take a credit, and you are happy.
The obligation to give credit or exemption is not just because you have paid tax in the other country. It should be taxed not in contravention of the treaty. Is the treaty also permitting levy tax there? Because the language used in the article is it is taxed in accordance with the treaty. Other country is taxing if contravention of the treaty, the resident country, you will start manipulating your practices and then wrongly collecting taxes. The resident country will not be obliged to forego the revenue. So the treaty language is if the other country is taxing in accordance with the treaty, then only it's obligation to give it this 1 minute. The AC you can switch off, please.
Oh, if it is taxed in yes in accordance with the treaty,
In accordance with the treaty,
then you can take a tax credit.
then he can claim credit. So
Yeah,
he has
this
to
is going to be
demonstrate.
taxed in yes according to the treaty.
So that's what. So whether it is in accordance with the treaty or not, who has to decide? R has to give credit.
No,
So
yes,
therefore,
you can take a certificate from yes that it is as per the treaty.
R says no. I don't agree with this understanding of the treaty.
Okay.
The problem is the two countries are having different understandings of treaty. So then whether R should submit or not. If the R is convinced that it is not treaty problem, it is because domestic law provides something different there, then R will give credit. If you are saying no, my reading of treaty is different, your reading of treaty is different, then R is not obliged to give credit. That's the because R has to give credit, then R is the judge. So that's how they have gone about it. I don't find any legal justification, but that's probably the most practical approach possible.
Then that will go against the attraction of investments in that particular country, right? No.
See, there are too many conflicting ends to be tied up. Too many conflicting ends to be achieved. Somewhere you forego, somewhere you accept it. So that's how they have agreed upon. So we'll now deal with credit method. The basic construct is the same. What it says is, if the income is derived in the other country, if the income is sourced from the other country, and the income is in the nature of interest, dividend, FTS, royalty, etc., then the resident country is obliged to give deduction of the tax paid in that country from its own tax slab.
Resident of the person who receives the interest.
Who receives the income? So while in the exemption, if the particular treaty follows exemption method, it will have this limited. This is limited credit method because it is dealing only with interest income, dividend income, royalty FTS. But if the whole method itself is credit method in a particular treaty, then there will not be reference to Article 10 and 11. It will talk about any income which may be taxed in the other country as per the convention. Then the resident country is obliged to give credit of the tax paid in that country. The last bullet is very important. What it says is that such deduction is the deduction of the tax paid in that country from the tax liability in the resident country. the deduction shall not, however, exceed that part of the tax which is attributable to such income derived from the other. So basically it says proportionate. In thumb rule, if we can say, it will not exceed that part of the tax which is Indian tax, that part of Indian tax which is attributable to income derived from other country. There is very interesting proposition
It
in all
will
of
not
this.
be, no sir. It will not be unless the other country has got a higher percentage of tax than India.
Not only that, there are cases where in India you have claimed some deduction like 10 or something.
Okay,
Okay, or you have set off some losses brought forward.
perfect,
So your tax liability in India will be much reduced.
correct.
Okay, so I will just deal with some example and case studies.
So, you cannot, just because the tax liability in India is getting reduced, can you refuse that the double taxation benefit which he is otherwise entitled to on these 3 points
It
in
will,
India?
it will not be refused, it will be reduced.
You are right, yes, it is reduced.
Reduced. We'll see,
Because they
we'll see
say
there are some
because
examples of that.
tax attributable, it is not just tax. So you
Which is
calculate
attributable
the-
to that income.
you
That's what they have.
calculate
See,
the
two
average
countries
tax,
agree
here
on.
average tax, then you take a credit.
Two countries
If you are
agree on
not
that.
taxable, you don't get it. But whereas in USA, you can take the next year's, next taxation also. But here it is not.
So in this credit also, if the last limb is not there, this attributable thing is not there, it will be full credit method.
You are right.
If it is there, it will be called as proportionate credit or normal ordinary credit. So just for the sake of simplicity, one illustration mathematical. So 60,000 income from the resident state and 40,000 from source state.
Sir, sorry to intervene.
Yes.
You mentioned about the Madras High Court case, the Lakshmi cotton
Lakshmi, sir.
exporters.
Yes, yes.
That's a Madras High Court case. I
Yes.
think the tribunal in Bangalore need not
Need not-
agree to that, right?
You know.
Unless it's a Supreme Court judgment, the other state tribunals need not bother about the other High Court judgments, right?
There is, it's all very, very, personality driven thing. There is a Bombay High Court judgment which says if there is a solitary High Court judgment on an issue, then all lower authorities are supposed to follow it. If there are two High Court judgments which are conflicting, they can choose what appeals to them. If there is a solitary judgment of High Court, then the tribunal is supposed to follow it. But the problem is tribunal said this is Bombay High Court, I don't follow this also. I don't follow the rule linked code, I don't follow the rule other code. So that's, but largely, some 80-90%, 85% we see that they are able to follow the High Court judgments. There will be 20% cases where they say, no, I have my own understanding, I don't care about what some High Court says unless it's Karnataka High Court. So coming back to this illustration, in the state R there is 60,000 income and in the state of source there is 40,000. Total income is 1 lakh. Now we are in the credit method, so the resident country will tax the entire amount. So state R say 35% tax rate in first case scenario. In second case scenario, in the state R's tax rate remains the same. But source state say if it is 20% in scenario 1 and 40% in scenario 2. What will happen is tax payable in the state R is 35,000 on 35% on 1 lakh. And state S will tax 20% on 40,000, which is 8,000. Now the tax which is paid in the state R on this 40,000 of source income, source state income, 35% tax rate, 14,000 is the tax liability in resident state. But what has been paid actually in the other country is only 8,000. So credit is only 8,000. But in the other case scenario, when the tax rate of the source country raises up to 40%, it becomes 16,000. While in the resident country you are paying only 14,000, so credit will be reduced to 14,000. That's the impact of the last limb which we read is attributable to. But there are a little more nuances to this. We will see some case studies on 10W also. In a full credit method, if the last limb is not there, then entire 16,000 will become creditable, which is, I think, hardly there in one treaty with India. Now, there may be a particular treaty in which there is an additional supplemental clause. most of the treaties do not contain these clauses, but certain treaties which will contain what is called as underlying tax credit. So this underlying tax credit clause eliminates or reduces the economic double taxation. So typical understanding is treaties are meant for avoiding juridical double taxation, but the reality is there are various clauses which also facilitate avoiding or mitigating economic double taxation. So what this article is meant for is, if there is a dividend declared by a company to its parent or this thing, then the parent company in its country, when it is taking the tax credit, it will not only take credit of the dividend TDS on dividend in that, but also take credit of the tax on the profits from which dividend has been paid. We'll understand this with the help of an example also, but we'll read the text, because the moment we read the text of the article, we'll get clarity. If this kind of a text is there in the relevant treaty, we can claim underlying tax credit. I'll read it out for your convenience. In the case of dividend paid by a company which is resident of Mauritius, I'm talking about India-Mauritius treaty, to a company which is resident of India. So Mauritius company is paying dividend to Indian company, and Indian company owns at least 10% of the shares of the Mauritius company which is paying dividend. Then the credit shall take into account, in addition to any Mauritius tax payable on the dividend, etc., it will also take into account the Mauritius tax payable by the company instead of profits out of which dividend is given. So credit will take into account not only the TDS deducted on dividend, but also the tax paid by the Mauritius company on the profit from which it has paid the dividend. If this kind of a clause is there, how the mechanics will look like is something like this. It's a hypothetical example. I have tweaked the reality to add into certain points here. See, there is a company in Singapore and it has earned 1 lakh of income. It is 50% of the Singaporean company is held by Indian company. So Indian company holds 50%, remaining 50% somebody else will be not concerned. And this company declares entire amount of profit earned as dividend after paying tax on that. So it has, suppose in that country tax rate is 30%. So it has earned 1 lakh, it will pay 30% tax and it will distribute the entire dividend 70,000. So 70,000 will be received by two shareholders, one Indian company and remaining somebody else. Indian company is having 50% stake, it will receive 35,000. Okay. And on that 35,000 there will be TDS withheld in the Singapore, which assuming 5%. So illustratively, numerically, how would it look like is the 1 lakh of income earned by Singaporean company, 30,000, 30% tax paid by it, distributable profit 70,000 and 70,000 on that 5% TDS, and then it has been distributed. Indian company income is 35,000, which is half of the 70,000 distributed by the Singaporean company. And in India, tax paid on that is 40% assuming, which comes to 14,000. Now, what is the FTC available total is? One is half of the 5% which is withholding tax there, and half of the corporate tax on the profits. Corporate tax on the profits was 30,000, half of that 15,000. So 15,000 and 1750. These two amounts are available for credit. But the thing is, in India, the tax itself is 14,000, so the total credit will not exceed that. Up to 14,000 you will claim credit. India no tax, only tax in that country. So just to illustrate how mechanics work. The another concept is tax sparing credit. Now, if a particular treaty has this kind of a clause, we'll see how the clause is worded typically is. If that kind of a clause is there, then even if tax is spared, means which is not levied, it is spared, not levied at all, not collected at all, that hypothetical tax will also be eligible for credit. What happens conceptually is, the source country says, I want to develop industry in my country, I want to give incentives. The source country gives incentives and therefore doesn't levy tax or levies less tax. It wants to attract investment. Now the resident country taxes the entire amount. the company in the resident country has no incentive to come here. Even though I am giving incentives, effectively they have to pay full tax there. So therefore, some countries negotiate this kind of a clause that I am giving incentive, you please give credit for that. So how this clause will be worded is something like this. It says for the purposes of, I am taking India, Canada as an example. It is slightly outdated, but for the sake of conceptual clarity. For the purpose of paragraph 2A, 2A is the basic FTC clause. The tax payable in India shall include or deemed to include the tax which would have been payable but for a deduction granted under any of the following sections. So, but for a deduction given under section 10, 15 or 80HHD or 10A, etc., if these deductions are given, because of which there is no tax or less tax, then what you will do? You will hypothetically calculate tax, eliminate the deduction, on the enhanced income calculate tax, then extra tax will also be eligible as deduction.
Sir, in the example you gave, Indian company owns 50% in the Mauritian company and
That's a different.
another 50% is with say US.
Yes.
Instead of 50-50, suppose Indian company is 40% and the US company is 60%.
Correct, correct.
In that case, the corporate veil will get pierced and it will not be treated as a treaty between Mauritius and India, but it will be treated as a, because the company in Mauritius will act according to the instructions of the company in the US. Like you remember this Birla AT&T case. AT&T US held the 100% of the shares in the AT&T Mauritius. And AT&T Mauritius had to operate according to the instructions of AT&T US. So, the capital gains from India for the transfer of Aditya Birla Group shares and also the Tata Industries in favor of the Mauritian company, the TDS was not deducted, even though Birla Group went and asked the officer refused to give the answer because he cannot be providing expert opinions. So in that context, since TDS was not deducted, thinking that it is a treaty between Mauritius and India, but the corporate veil was pierced. It is the Mohan Parasharan was the Additional Solicitor General at that time who argued for the revenue. And it has to be treated as a transaction between India and US, and therefore there is a violation of TDS remittance. This was concluded. So,
I somehow don't remember.
Depending upon the percentage of shareholding in the subsidiary company, who has the management control over the country or the company will decide whether the treaty is between the Mauritian company and India or the ultimate holding company, that country and India, and you have to decide on the which country's DTAA we have to follow. This is what that judgment says.
I don't remember that, but if I have to take it on principles, number one, maybe in the speed of things, I missed pointing out certain element. The article will typically mention, this underlying tax credit article will typically mention the percentage holding which is required to invoke that article. So it is sometimes 10%, 20%, 25%.
Yes, yes.
So if, for example, the article which we read, which we talked about 10% holding, we read this India, Mauritius. India, Mauritius, at least 10% holding should be there. So article says, the moment you have 10% shareholding, I will give you a direct credit. There, it may be very difficult to say that no, 90% is somewhere else, he is controlling everything. Then you should not have agreed upon 10%. If you have agreed on 10%, you are gone with that. So this kind of a provision, if it is there, it may take care of that problem. Now coming to the different concept, this is underlying tax credit. This is tax sparing. Tax sparing, we read the article partially, that if because of certain specified deductions, okay, the tax is not levied and spared, then the hypothetical quantum of tax will also be eligible for credit. Now in this context, there have been some judgments, though there is not very material, but for the sake of completeness, because some of the articles would say that if the tax is so-called not levied for promoting economic development, for promoting industrial development, something like that. If that kind of phrase has been under question, So there have been two kind of controversies so far in this kind of article. One is revenue contended in one case, because there is no tax paid there on what is the credit for? There is no payment of tax there, there is exemption, deduction, there is no payment of, how can I give credit? The courts at the two countries have agreed, they will give credit for tax even not paid. You please do. Okay, so therefore that's what the judgment of Polyplex Corporation recently upheld by Supreme Court. Then there is another two set of judgments which where the court with the revenue wanted to argue that the article says if the tax is not levied for promoting economic development, you first demonstrate that the exemption given there is for promoting economic development. In one case, that fellow was able to obtain a clarification from Ministry of Oman that this is for the promotion of economic development. Then they granted based on the clarification given by the ministry. In the case of Polyplex Corporation, the debate was not very strong, but the assessee demonstrated from the exemption section of the domestic law. If it is English language used, then it is relatively easy to demonstrate. You can read and translate and give. So they reproduce the section was clear, it is for promotion of economic development, exemption is being given. We don't find these kind of drafting in our income tax 1961. But their law was a little more differently drafted, they clarified the section itself. So they gave on that basis. Then in the Bangalore tribunal, the department insisted, getting probably influence from the Krishak Bharti, that you obtain a clarification from there. The tribunal had, because there is no requirement in the text of the treaty to obtain clarification or certification or something. So they have given the benefit without, number one, any certification, clarification. Number two, independently also there is no discussion how it is so, because at least in the Polyplex, the assessee was able to demonstrate from reading of the section. In Krishak Bharti, he was able to demonstrate through the clarification. In this section, how did they inspire the confidence that the condition has not no clarity? So, but there is a judgment in support.
Sorry, under DTA, there is a clause where exchange of information is there. Why did this income tax department, Indian, did not ask the detail of that instead
very,
of...
very rarely, very, it's cumbersome process.
Sir, they are calling left and right chartered.
They are calling, sir, but if in my 20 cases they have called for information, only 2 cases they have got information. Very, there is no great cooperation from most of the countries I see. And even if they get something, it is not useful and they don't find what to do with that. Ultimately, we are, in some cases, we have challenged that you have frivolously called for the information. There was nothing, no requirement. You wanted to buy time of 1 more year, your assessment is time barred. So we have yet to see the light of the day. We have raised the argument, we are still before the commissioner is working.
Even auditor was called in and
So now we come to section 91, which is unilateral credit. Section 91 says that if a resident of India proves that he has paid a tax in the other country.
So section 91 means under the income tax act.
Under the income tax act, when there is no treaty. When there is no treaty. Okay, we have read the articles of the treaty. We read section 91 and then we go to some more case studies. So the section 91 says if there is no treaty between the two countries, and that also is little, we will see there is some problem in that also. If you have paid tax in the other country on an income which is accruing arising there, not deemed to accrue in India, and you have paid tax there, then India will give credit provided there is no treaty between the two countries, and the deduction shall be given of the tax paid there from the tax paid on doubly taxed income. Now, what is this doubly taxed income? There is no definition of doubly taxed income. They say from the tax paid on doubly taxed income. So, how to arrive at this doubly taxed income? We'll see some illustrations. Not very complicated, but there can be some situations more complicated. So, you have to give.
Do you have definition in under section 2 for doubly taxed income?
No. This is some Supreme Court judgment is there in some situation, some other judgment in some situation. So, we will try to understand from the help of these judgments. So, first you have to arrive at what is the quantum of doubly taxed income. Mathematically, if you see numerically, quantum of doubly taxed income, which is income tax here as well as there, then you arrive at 2 rates. One, Indian tax rate, other foreign tax rate. How you arrive at Indian tax total divided by Indian total income. Foreign tax rate, total foreign tax assessed divided by income assessed in that country. Okay, so you take lower of the two rates, multiply by doubly taxed income, that is your quantum of tax credit. Unilaterally, there is no.
Oh, only the lower of the two.
Lower of the two. Okay. So mathematically, I have just put a little gloomy illustration. So 10 lakhs is the country, is the income in the resident country, including the source country income. 7 lakhs within the resident, 3 lakhs source country, total 10 lakhs in the resident country. This thing, resident country taxed at 15% and source country taxed at 33.50%. Lower of the two is 15%. Doubly taxed income is 3 lakhs. So 3 lakhs, 45,000 is the tax FTC available in this. So there has been a case, there is a treaty between India and USA. USA has double structure, it is federal tax is also levied and state tax is also levied. The India-US treaty gives credit for federal taxes, it does not consider the state taxes. So this gentleman, Manpreet Singh Gambhir, wanted to claim credit of
Local
state taxes paid in this thing under treaty. The tribunal denied, there is, the treaty clearly says taxes covered and there is a federal taxes levied in US. Therefore, the state taxes not to be given credit. He lost the case. The other set of taxpayers learned from his problem. They said we will not claim under treaty, we will claim under the 91. Now 91 clearly says when it is, there is no treaty. How they have been able to overcome is slightly tricky. What they say is, they say if you see the rate of tax, there is a definition of rate of tax in that. This thing, they simply saw the definition of that and they say you take a tax paid there, you divide this thing up, particularly you give the credit. They have simply kind of overlooked the requirement that there has to be a treaty between the two. Somehow on emotional grounds or whatever, these set of judgments which are given, including our Honorable Karnataka High Court has allowed the unilateral carried on this.
So if the revenue goes on appeal, it will not stand. I mean, this judgment will not stand.
It is so difficult to say what will stand. It is very easy to say what should stand. It should not stand the court of law, whether it will stand or not.
Yes.
Anything is happening in this today. A few days back there was a landmark judgment of Supreme Court in the case of this most favored nation clause. I don't know if somebody of you have read that. So there are surprises from courtroom. No, the Supreme Court surprises you most of the times. So whether we get a surprise here or not, we cannot say. It should not stand, but anything can stand. Okay. So
just here one point, sorry. Between India and US, the DTA very clearly says what is taxes. For example, what is taxes in India includes cess and but does not include interest and penalty. There, I think it is a federal as well as state tax. Only federal.
only.
Sir, this most favored nation is treaty with notification.
And that issue.
That issue only.
that issue. So now there is another facet to the entire game about foreign tax credit and exemption. The treaty only lays down the broad principle as to whether credit has to be given, what is the broad framework, but nuances have to flow from the domestic legislation. How to calculate exactly, on what are the other conditions, some form to be filed, etc. Those things flow from the domestic legislation. We did not have for a very long time any kind of provision or domestic law. Somewhere in 2015, Rule 128 was introduced, which gives you some elements as to what have to be complied with. So one thing they say is, it is for tax paid. You can claim credit only of a foreign tax paid. Now the moment they say word paid here, you get a problem on two counts. Number one, in a tax paying scenario, there is no tax paid. So Rule 128 has come, no, there should be tax paid. So there is a conflict between the rule and the treaty, and treaty is at par with the act kind of. It was act surrender in terms of the treaty. Section 4 says, subject to rest of the act, there shall be charge of tax. Subject to rest of the act includes section 90. So section 4 is subject to 90. 90 is what is empowers the treaty. Therefore, charge in the act itself is subject to treaty. So treaty is supreme, then the act is what the common understanding is. If that is the case, the rule being a subordinate legislation cannot cut down this thing. But there is a, as of now, there is a kind of problem. Then there is a temporal aspect as to when, in which year you will claim the credit. In the year in which you offer the relevant income to tax in India. There may be timing mismatch, you pay tax in different time zones there, you are offering this income in a different time zone there. So you claim the credit in the year in which you offer the relevant income to tax in India. And the FTC is against tax, surcharge, cess, etc., everything put together. And how to calculate that, this thing they give a guidance that you compute this FTC amount on source basis. Each country, each source separately. So there may be a source of which has given you a loss. There may be a source which has given you this thing, income. Don't aggregate. Compute on a separate. Germany 3 sources, France 2 sources. For 45 different calculations, aggregate that. Now this itself gives you a lot of complexity. Number one, you don't compute Indian income. Source-wise P&L is not there. How do you compute? That's one challenge. Then what is the source? Is source meaning different heads of income under the act? Is source meaning the different classifications under the treaty? Or is source meaning that 3 business, 3 are different source? I have 3 different projects there, they are all 3 different sources, no clarity on that. So you are free to do whatever you want to do. When there is nothing in the legislation, you are free bird. And it also says, if the foreign tax is excess than the tax liability in India, excess is to be ignored. There is no refund possible, and that even without this rule, there are judgments which say refund is not possible. So on a compliance framework, there is some form 67 to be filed, and there is a certificate to be given of the nature of income, quantum of tax paid, etc. There has been some problem that if there is a dispute of the foreign tax in that country, whether you are liable to pay tax in France or not, that still is in dispute. You want to claim refund, they have taxed it, the dispute is going on. Then by the time your assessment happens here, your dispute is not settled. So you are not able to file your forms, etc. You are not able to make the claim. Then now recently this section 155 has been amended to say that the day when the dispute settles in that country, within 6 months of that, you come here and you make your claim, you will rectify the order. Now here we take a case of the doubly tax income also and other thing also. Say take an illustration where a person who is resident of state R has 25 lakhs of income from source state, and tax paid in that country is 20%, which is 25 lakhs multiplied 20% is 5 lakhs tax paid, and income from resident is 1 crore. So total income becomes 1 crore plus 25 lakhs, 1 crore 25 lakhs. In India, he claims 50% deduction under section 10AA. So his taxable income becomes 62,50,000, and he pays India tax at 15%. Now whether FTC can be claimed on the entire 25 lakhs or only 12,50,000, which is half of after 10AA deduction. So we read there that doubly taxed income. How do we ascertain this doubly taxed income? Do we say that I can claim FTC for entire 25 lakhs, or do I say that I can claim FTC only for half of it, because for remaining half I have got 10AA. That is not effectively taxed. So any thoughts on this? So I have been little mischievous. I have been little mischievous in asking this question. The question should really be, are we talking about unilateral credit under 91, or are we talking about bilateral treaty situation? The answer is going to be a little different between the two. Okay.
Sir, of course, I am not able to answer the specific to your unilateral or double taxation thing. Since he has claimed 50% of 25 lakhs
Yeah.
also,
Yes.
if you had claimed only 50 lakhs, I mean 1 lakh, 1 crore only into 50%,
Then it will
then he could have got benefit of that entire tax paid on 25 lakhs. He has already taken credit there also, therefore 12.5 lakhs only he can get. Is my limited
Fair
understanding.
enough, fair enough. I also have limited understanding only, sir. Courts also have limited understanding only.
So this will not come.
With all due respect, what they write becomes the understanding.
This is a typical case of tax attributable to the income. So 12,50,000
You
is the...
have next 10 minutes discussion you have finished.
Sorry.
Exactly, sir. Perfect.
No, please go ahead.
We are bang on the point, but I'll just tell you something which may be useful. Okay. So in a section 91 kind of a case, what is doubly taxed is there are these set of judgments which say only half. After the deduction, what get really taxed is the doubly taxed income. But our Honorable Madras High Court said, no, full. They say, no, don't look at the quantum, look at the nature. The nature is that it is taxable in India. Therefore, it is doubly taxed. It
You
is,
will return the tax on balance 1250 lakhs. See, if they are going to
become
get
a
the deduction
refund
for 25 lakh, they are paying tax only for 12 lakh 50. Then
so what will happen typically is, in India you have paid 9,37,500 on 62,50,000,
correct.
on which you will claim entire 5 lakhs. Which is, so in Tamil Nadu people can have celebration. Okay.
But they can have-
How far that will last, that's a different question.
Department would have gone to the...
I don't think there is an appeal against that judgment. So that's one more problem. The very interesting situation. What has happened is there are series of Supreme Court judgments which said that Mr. Revenue Officer, you did not file appeal against this. That means you have accepted this. We will not allow you to pick and choose. Some assessee will file appeal against same proposition, some appeal will not file. That discrimination will not allow to happen. You will not entertain that also. But they paid one
Refer
Supreme
it
Court.
back again.
Huh?
They will refer it back to the assessing.
No, nothing finished. Appeal not entertained.
Oh, appeal itself is not entertained.
Berger paid Supreme Court is there, various other Supreme Court judgments. Not a very good proposition, but Supreme Court is doing so. So you go ahead with this kind of thing and then say, no, we are not filed appeal against that.
So moral of the story is you file an appeal for all the assessment years. If you want to do it for one particular
Moral for the department, but let's not. Okay, so so this is the 91, section 91. We have a very thin case, except for this Best and Crompton Madras High Court. There is no chance. But it comes to treaty. In treaty also, what happens is there is, for example, to take a case of India-Canada treaty. It says the amount of Canadian tax paid under the laws of Canada and in accordance with the provision of this agreement, whether directly or by deduction, by a resident of India in respect of income from sources within Canada which has been subjected to tax in India and Canada. So it says that FTC is available only if income is subjected to tax in India as well as Canada. This is not subjected to tax. Now there are some treaties which use the word subject to tax and some uses subjected. So ED is a difference. Subjected versus subject. So the international commentaries say that if it says subject to tax, means liability to tax is there. Actually taxed or not doesn't matter. If the word is subjected to tax, it has actually suffered tax. So based on the language used in this treaty, Honorable Karnataka High Court and Bangalore Tribunal and couple of other judgments have held that you cannot claim credit on entire 25 lakhs, it will be only qua half of it. So same answer as 91 if this kind of a language is there. The very same judgments had different treaty also before that. So the very same Karnataka High Court judgment in the case of Wipro dealt with India, Canada also and India US also. When it read India US treaty, it arrived at a different conclusion. It said that this treaty, India US does not have this subjected to tax in both these states. This language is missing here. Therefore, here you can claim credit.
So subject to tax means entire 25 lakhs is subject to tax. Subjected to tax is only 12.5
Only
lakhs.
12.
So here So you said you
In
interpreted
India, Canada, subjected to tax was there, so only half.
Ah,
In this, neither subject nor subject, nothing is there. In this India, USA, I will read it out. The kind of language is absolutely missing. It says, where the Indian resident derives income, which in accordance with the provision of this convention may be taxed in US, India shall allow as a reduction from tax on income of that resident an amount equal to tax paid in US. Income derived from the state may be taxed in that state according to the convention. Tax paid. Finished. Now, there is such attributable to. In this also, that phrase is there. It says such credit shall not however exceed that part of Indian income tax which is attributable to income which has been taxed there. No, Indian income tax is how much? 9,37,000. How much that is attributable to that income? That phrase, revenue did not highlight. See, revenue has to argue no. Between two people, if there is a fight, the one who wins is not necessarily who is right, but the one who has might. So you do not be right, you have to have might. So revenue was weak in terms of, he was not able to canvass this proposition. You cannot look at the attributable to word. And if there is a Supreme Court judgment to be looked into, so there are series of judgments which have not considered attributable because revenue did not argue, they have given the benefit. In a very, very different context, the word attributable was interpreted by Supreme Court. They say there should be causal connection, which is cause and effect connection. Something is attributable to that if there is a cause and effect connection between the two. So tax is attributable to that income if there is a cause connection between the income and tax that is missing. So if this Supreme Court judgment is quoted and the interpretable word is highlighted, then this judgments may not sustain in the Supreme Court. Now the thing is, whether somebody will quote this, see today it becomes very challenging to advise somebody. Somebody asks you, sir, can I claim this? No, you cannot. There are so many judgments, all wrong. You are better than judges. You know more. And why you have come to me? Go with the judges and what business. Okay.
Sir, one question, sir. Generally, the principle is a resident will be taxed on his global income.
Correct.
So, in the source country, not only that part of the income that has arisen in that country, should not the Indian income also get added and then taxed?
No, he is not resident there. He is resident here.
Resident.
If it is if it is resident in two countries, first we have to resolve that conflict. Now, Article 4, you have to become resident of one country by resorting to tiebreaker rule or mutual agreement procedure or something. Then you come to this.
So, if such a situation arises where his Indian income also gets clubbed over there, then FTC also he can claim in respect of that also in India, right?
See, if the problem is, first you have to ascertain by referring to tiebreaker rule of Article 4, in which country he should finally be resident. He cannot be resident under both the countries.
Yes.
He may be resident under both countries as per domestic law, but as per treaty he should be resident of only one country. Only then the treaty works. So first you ascertain that, and then one country becomes host country. That country will not be entitled to tax globally. Okay.
Sir,
No.
one point here, this US taxation for a Indian foreign alien.
Sorry?
Sir, for a foreign alien.
Foreign
in
alien.
US station, then you file 1040 and there it takes the global income. It takes Indian income also. What is the income he got? A resident of
The
America.
US is slightly typical. I am not very thorough with that. I am not very thorough with that. No.
Even I am not.
They taxed on the basis of citizenship.
Correct.
They don't go by residential status, they go by citizenship.
Yeah,
That's some-
citizenship.
Ah.
You see, just again is this. Again is the law of taxing residents in the country. They don't take, of course, they take the global income, but when you are taxing Indian, this one, you take the global income, but not the way they do it.
Yeah, I'm not very thorough with that, so I will not comment on that. Okay. So, in terms of quantum, there is, I was referring to doubly taxed income. So, what happens in a particular case is there is a business loss in India and there is business income outside India. And there is income from other sources in India. So, in India, there is 65,000 of loss from business, there is 35,000 of income from other sources. Now, do we take doubly taxed income as since there is a business income outside India, business loss in India, doubly taxed income is net of the group. Or the doubly taxed income is 1 lakh foreign income minus India loss plus income from other sources. Entire 70,000 is doubly taxed, or you go headwise, source wise. How you arrive at doubly taxed income? There at least the Supreme Court in the case of Ramanathan Chettiar said, doubly taxed income you don't go by the source wise, head wise, you go by the aggregate. If that 1 lakh has got assimilated in Indian tax, Indian income, yes. So it is doubly taxed. It is taxed there, it is taxed there.
So 1 lakh has to be treated as the doubly taxed income.
70,000, because in India 70,000 is doubly taxed. 1 lakh is taxed there. Here we had a loss because of that income got reduced to 70,000 gross profit. So 70,000 is the. So taking another case, if there is a loss in the source state. Now, if you take exemption method, how it will happen? If you take credit method, how will it happen? We'll see both the methods. So typically, the understanding is, if an income from particular source is exempt, then the loss from that source is also not to be set off. So if you apply that rationale, what will happen is, in India 1 lakh income, foreign loss you will ignore, and next year in foreign country you will set off that loss there. So in the next year 70,000 of income is there. You will set off the 35,000 of loss there, and 40,000 of income is net there. In here, India, resident country, 1,20,000 is income next year, and source income is exemption method. So loss will be only set off in the source country. You will not set off loss in the India because loss from exempt source. That's the normal mindset. But here is a case where it is not exemption per se. It is non-taxation because of treaty. So what you will typically do is, you will say, no. If there is a loss in the foreign country, I will not invoke treaty. Act is more beneficial. Under the act, foreign income is also taxable. Foreign loss is also set off.
Yes.
So what you will do is, in typically what you do is, you will set off that foreign loss in India. Your 1 lakh will get reduced to 65,000. Now, will you also set off, carry forward that loss in the source country? Of course, yes. So, either be set off, they are also set off. In the next year, you earn 1,20,000 here. Your income in that country is 75,000. 75,000 minus 35,000 of loss carry brought forward, with net income is 40,000. The question is, will you give exemption of the 75,000 or 40,000? Basically, treaty says an income which may be taxed there, you have to give exemption. Will you give exemption of entire amount? If you give exemption of entire amount, there will be a double, what they call double dip. You have got benefit here also, you have got benefit there also, which is unfair. But is it unlawful?
Sir, for ascertaining the income, keep the DT aside, for ascertaining income, they have to go by setting up the losses next year only. In India, we cannot take that credit, no, because the system, how do you arrive at the income in India and foreign? Whatever the income there, and if there is a loss, they have to carry forward.
No, they are carry forward.
How
But
can
in
they set
India,
up?
you are liable to, you are resident in India. You are liable to global income.
Yeah.
With global income includable, global loss also includable. So loss becomes available for set off here. That's a typical. There is a actually judgment of Supreme Court of the Carrier Company. There is agricultural loss outside India. So they say agriculture income is exempt only if it is agriculture in India. Here is a case of agriculture outside India. That's a loss available for set off. Carry on. Okay. So following that, it's a big question as to whether exemption will be of only 40,000. Now, how to find an answer? Interesting, very interestingly.
Sir, the previous case. This slide.
I am on that case only.
No.
Next slide, yeah.
Second year, second legislation. 40,000 is taxable income outside India.
Yes.
So tax will be naturally be lower. Tax will be only on 40,000.
Correct. So if
So
it is if it is a case of foreign tax credit, you're absolutely right. There is no problem at all. We'll see that side also. That's after monthly. This is exemption method we are seeing for the moment. In exemption method, the question is whether you exempt entire 75,000 or you exempt only 40,000. We are this whole issue of foreign tax credit or exemption is under Article 23 of the OECD. But the answer for this question flows from Article 24, which deals with non-discrimination. So, non-discrimination clause, Article 24 has a clause which says that permanent establishment shall be taxable in a manner which is not less favorable than the resident. For example, there is a permanent establishment of a US company in India. The taxation imposed on the PE should not be less favorable than the taxation imposed on the resident of the country, resident of India. So, invoking that article, the PE may say that in the PE country I am entitled to carry forward. So, carry forward in the source state is not hindered. That OECD at least permits it. The Clause Vogel, which is a very eminent authority on the international taxation, treaty interpretation, he says that it is unfair to claim that loss in both the countries. But to address that problem is the responsibility of the resident country. Resident country has to have some domestic legislation to prevent that. Treaty, there is no provision in the treaty which can prevent that. Treaty exemption will be of entire 75,000. So it says it is an unsatisfactory situation, but if at all you want to address it, the resident country has to provide something domestic law. So unless there is domestic law provision, this double advantage is kind of possible.
So year 2 also you will add only 40.
Exemption also, no taxation at all. No, not to be included neither 75,000 nor 40,000. Not to be foreign income, not to foreign loss you have set off, but foreign income you are not including. Foreign loss in the first year, you say I will follow the act, you set off. Next year I will follow the treaty, full exemption. So double advantage. Now take a case of credit. The moment you take a case of credit, the problem automatically solves, because as sir said, in the next year, your tax is only on the 40,000. That is what you will claim credit. So if you are taking set off in both the things, it is just a temporary item. Next year it will get resolved. So there is a judgment of Honorable Pune Tribunal in the case of Bhakti Computers, which say that in a credit scenario, there is no problem. Now take a case where there is a different calendar year. The source state follows, say for example, June to May, and the resident state follows April to March. There is a project I have done, resident country, resident fellow has done in the source state of project in particular September month. So September 21 he does a project there, he earns income there. That income is taxable in June to May period there, is taxable in April to May, there is no difficulty. It's a simple case. You can claim credit without any challenge. But what happens in a case of a PE in a foreign country? Say that PE state follows June to May. We are here following April to March. So there is a slight disconnect between the two calendar years, tax years. In this kind of scenario, there is no judgment, there is no guidance. But what practically we do is, we split the two periods. For the income and tax from April to April to May, we take in 1 year, and from June to March, we take in another year. So, only way is to apportion the total tax and total income in two splits. Take one parallel in 1 year, take another parallel in another year.
But instead you can go by the assessment year route. And
Different rules.
previous assessment year you take it for your current assessment.
But
because assessment year is always going to be April and March.
That's
Whole world.
fair, that's fair. But what has happened is, there is, in the whole year you have earned 12 lakhs of income. You have earned 12 lakhs from June to May there. Out of that 12 lakhs, what you have offered in April to March is only 10 lakhs. Rest of the 2 lakhs will go in the next financial year.
Yes.
So because you are offering that income in 2 different financial years, the only way is to apportion that.
for my understanding. Sir, the exemption route is section 91, right?
Sorry, section 91 is unilateral credit when
Yeah.
there is no treaty at all.
No treaty at all.
Then within the treaty, it depends upon a particular treaty. One treaty may have exemption method plus credit for the dividend interest royalty.
Right.
Other treaty will have credit method for all types of.
Okay. So if it is a credit method, this confusion of 75-40 doesn't arise.
Will not.
Exemption route, if you can just.
In exemption,
Ah.
going back to the numerical example, what happens is in the year one, you are saying even though under treaty I am supposed to exempt and this thing, but under the act I am able to set off. I will follow the act more beneficial. I will set off that loss.
Your first table is okay.
The second table.
Second table,
May in the year one in the resident state he says the loss of foreign country I will set off in my resident country.
Yeah.
I will set off in resident country also, I will carry forward in the source country also. So I have reduced my resident country income, I have reduced my source country income
perfect,
by following the next year.
perfect.
So in the next year, when the source country may, the tax is only on the 40,000 which is after setting off the profit or loss. The basic income is 75, the net income after loss is 40. How much you will exempt in your country? Will you exempt entire 75,000? Under the treaty obligation is to exempt entire 70. The moment you exempt entire 70, that has a double benefit. Because you have taken benefit there, you have taken benefit there. That double advantage, if some country wants to address, it has to provide in the domestic, because treaty there doesn't deal with.
Currently, India has not addressed them.
I'm just skipping something which is not very critical. So take another example. On quantum of income, which we saw doubly taxed income, something connected to that. Now there is a permanent establishment in the other country. That P, say I have P in Germany. German tax authority says your P income is 15 crores. Our Indian assessing officer is very smart. He says no, they are wrongly computing income of 15 crores. According to me, P income is only 12 crores.
Oh.
Why he wants to say that? In any case, entire income is taxable here. But the moment he says your P income is 12 crores, your entitlement to claim credit reduces to whether he is entitled to say so. And if he says so, no.
For the foreign jurisdiction, he has no jurisdiction to assess.
Now, if you go by the Lakshmi Textile case, then he is bound by what the other country has done.
Correct.
Okay. If you go by otherwise the text of the treaty, you have to say whether the other country has taxed in accordance with the treaty. And who will decide whether other country has taxed in accordance with the treaty? A resident state. So there is some dichotomy between this thing. And if you also see Article 7, Para 2 of the OECD Model Convention, which is typically there in most of the treaties, it says in a PE case, income attributable to P shall be computed by both the states for their own purposes. It clearly permits for the Article 23 the attribution quantum to be determined by both the countries independently. So he can do that. The only way to resolve this is to go to mutual agreement procedure. Both the competent bodies of two states have to sit together and resolve it.
Sir, both the countries are entitled to compute the PE income
In
in accordance with the laws of the source country.
In accordance with their own understanding, sir. What the P is P, it is income attributable to P. Then we have to attribute how you understand. You will understand attributable word according to your domestic law. Because the treaty does not define what is attributable. When the treaty does not define a particular phrase, you have to understand the phrase as per your domestic law. Then you have to assimilate your domestic practices. So that's how it works.
Sir, a German income cannot be computed as per Indian laws, sir.
That is one thing. First, there are two things. First is how to arrive at the profitability, the ideal profitability of the firm. Then the second thing is how do I factor the other element I'll come to a little later is what is the impact of domestic law deductions, exemptions and quantification of it. So it may so happen, I'll deal with the second thing first.
Yes.
But it may so happen that German says your P gross receipts minus basic expenses 15 crores. India also says gross receipts minus this thing 15 crores. They are at par on the P&L. On the commercial P&L, they both agree. But India says, I am giving you this deduction, that depreciation, extra, that thing. So India takes P&L. India says, I add back your P&L depreciation, I give you my depreciation. Your taxable quantum reduces. Just because of that, the FTC will be eligible on the India computed portion. Because that is what is getting taxed in India. That is one side of the story. So they are not supposed to see how the German is computing their taxable quantum. The other side of the story is the basic P&L itself. How they arrive at the P&L of the German PE. Because PE attribution is a notion in itself that maybe we can have a different session on that. But the thing there is, you have to arrive at what is attributable to PE, having out of function, assets and risk. Typically, what we follow is the transfer pricing mechanism for that. So we do something like a TP study for the P and arrive at how much should be the profitability, and that computation done by India will be significantly different from any other country. So if that difference happens, either you accept it and FTC will be eligible on the reduced quantum of income, or you go to mutual agreement procedure by making the competent authorities of the two countries sit together and negotiate to a common number. On the element,
Sir, can an officer decide on the arm's length price which is lower than the TP study suggested percentage? Because if a TP study suggested percentage matches with 15 crores, can the officer say no,
so
we
what
reduce it
happens,
and
sir,
build?
you have a PE in that country, you
Yes.
will file a TP study there.
Correct.
Here, in any case, whole amount is taxable. First of all, there will not be a TP compliance requirement. But you will do a TP study only to arrive at profitability, according to you. You will canvass that this is so, but the officer may not accept it. Now, in the interest of time, I am just skipping something which is not very crucial. I will just mention one element which is important. Here again, suppose the total tax paid in the country is 15 crores, but the FTC computed is 10 crores only. What happens to the remaining 5? We know that refund cannot be given. Now, whether can I claim this excess 5 as a section 37 deduction? This has been a contentious issue. Now, there is a section 40, clause 2, which says no, whatever is taxes paid on profits cannot be claimed as deduction. Therefore, we disallow our income tax. Whether foreign tax is also tax falling under that meaning of that clause. Then there is an explanation which says that whatever foreign tax which is eligible for credit cannot be disallowed, has to be disallowed. So people say the explanation is only for that foreign tax which is eligible for FTC. What is not eligible, 5 crores, is not disallowed. So it's a issue where arguments are from both the sides and there are judgments on both the sides. So there are yes saying judgments, there are no saying judgments. I will not get too much detail into that, but in my humble understanding, it is very thin proposition. It should not sustain. It doesn't seem to be very appealing proposition, because if we see the basic construct of the Income Tax Act is, another Supreme Court judgment they have referred to is the Indian Aluminium Company. The proposition laid down there is whether the expenditure, so-called expenditure, is incurred before you have earned the profits or after you have earned the profits. Is the expenditure because of running the business or because you have earned the profits? Income tax is an expenditure which is because you have made profits, not because you are doing business. You have to do business, I will do business. You are doing profit, I am doing loss. I will not pay tax. Both are doing business. So, existence of the tax expenditure is not because of business, it is because of profitability. So therefore, it is not an expenditure for reduction of profit, and there are a series of High Court judgments in the 1922 Act. Income Tax Act 1922 did not have any provision which is similar to 40A2. 40A2 denies income tax reduction. But when this kind of a section was not there in the 1922 Act, still a series of dozens of judgments denied the income tax reduction based on the principle that this is not because of business, this is because of profitability. So following that principle, this expenditure tax paid there in that country is also because of profitability. It's not the rule. That's my understanding.
So no is the correct answer you are saying.
That's my belief. But so many judgments are favorable. Most of the judgments are favorable. The against ones are limited in number. Now we'll take a triangular case and we'll finish with that. ABC Limited is a resident of state R and has a P in state E. The state R, resident state, and there's a P state E. And the company is a resident of state R and has a P in state E. As we discussed in the beginning, that P was given funds. Out of that funds, they decided to invest in some shares of the company in state S, third state. Now that S, third state is withholding dividend, withholding TDS on the dividend declared by company in that source state. E state taxes the dividend received because it is income attributable to P, because P is the owner, the economic owner of the share. S state is taxing because dividend originated from there. E state is taxing because P is there. R state will tax because residence is there.
So by being a PE, it must be only a branch of the company in the other country, right?
Right.
So it is not a legal entity, but it is the same entity. It is a branch. So in that case, even if it had purchased shares, using the funds transferred to it from the owner company,
Yes.
the shares will be in the name of that legal entity only.
You are right, sir. As we discussed in the beginning also, the authorized OECD approach treats the taxability based on economic ownership also. So P being economic owner, P state has a right to tax. R state has a right to tax because of residence. So as per authorized OECD approach, attribution will happen in the P country. The source country, S country will have right of tax because dividend is originating from that country. Now the real question is, who will give credit? How much they will give credit? In the P state, can credit be claimed of the tax paid in the source state? Or the tax will be, credit will be available only in the resident state of the two taxes paid in the P state. So suppose the dividend income, 10 rupees tax is deducted by the source state. In addition to that, 65 rupees is the tax paid in P state. Whether entire 75,000 becomes a burden of the resident state to give credit, or from 65 in the P state, first 10 rupees will be deducted as FTC, and resident state will give credit only of either 65 or 55. The illustration is clear, sir. 10 rupees deducted as dividend tax, the TDS or dividend in the source state. Resident country, the P country has 65 rupees of this thing. Whether P country will give any credit. Now the credit we have discussed in the beginning, credit has to be given by country of residence. Correct? So P is not resident of that country in the P state. In the P state, branch is not resident. It's a non-resident only, foreign company only. Now there it is an intermingling of Article 23 and Article 24. There's an Article 24 non-discrimination. We initially also somewhere in between I mentioned that. Article 24 non-discrimination typically has one clause which says a P in a country will be taxed not less favorably than
Your resident.
So they will first invoke, the P will first invoke Article 24 of the RE treaty. The resident treaty and E treaty, they will say, under my treaty, you should give me benefit as you give to the residents. Now, having claimed that residential benefit, they will say, now I go to ES treaty, you give me credit as if you had given to your own residents. there will be two treaties invoked. First treaty to get the residential status, kind of equivalent to.
But a PE is as good as a resident only, right?
As good as.
No, it will be taxed as a resident only, right?
It will be taxed as a foreign company, typically.
Foreign company.
Yes. Because number one, tax rate will be applicable as applicable to foreign companies.
Correct.
Number two, global income will not be taxed. Only the income attributable to you will be taxed. So this is significant. Okay. So therefore, two treaties intermingle here. First, they say I invoke the resident and PE countries treaty to get the residential status similarity benefit as given to the resident. Then, having acquired that, they say I go to ES treaty to claim the FTC. So 10 rupees will be claimed as FTC in the PE state. Cash outflow is 55. 65 out of 10 rupees that can be FTC. Now the net tax cost is 65. It doesn't become 75. Then comes the resident country. Resident country will, according to me, there is no great international literature I could get on this, and I don't claim to have been knowing the entire thing. According to me, it should give credit of 65 subject to calculations. But there is some school of thought that actual tax paid in the state is only 55, because 55 is 10 rupees has the same credit. It should give credit of 55 only, which effectively makes that 75 is the burden.
Sir, the tax of 65 you mentioned in the PE state is inclusive of the 10 rupees, 10,000?
Is including the tax of the dividend received.
It is
From
included.
from that 65, 10 rupees have to be given as credit. Now the tax cost is 65.
That
Out of
includes 10 also.
which include 10 also. So this 65 has to be given credit by the resident country as per their calculation subject to rest of the mechanics. So that's good. I will conclude the session. Thank you very much for being here. It was very interesting to have interaction with you. Thank you.
Members, no doubt all practicing chartered accountants will be updating themselves in international taxation and helping out their clients, but after notices under Foreign Currency Black Money Act started being received by many associates who have got any foreign currency asset, updating with relevant articles of DTAA and related case laws becomes very relevant. So, and this 2 hours would have refreshed your knowledge kitty. A round of applause for the fantastic CA Sumeet Khurana. On behalf of members present here and all the managing committee members of Bangalore branch, we would like to hand over a gift voucher to the speaker, and can I request Vice Chairman Pramod Arade to do the honors.